Hi there, good morning to all our viewers who've tuned in live to this Money Control broadcast. You're watching Opening Bell with me, Stacy Pereira, and I'm here as usual to take you through all the news and cues that you need to be watching out for that could go on to impact your trading day. But let me first set up the trade, what the day looks like and what we're going to see ahead of us. Of course, it's a long holiday, a weekend that we are anticipating, and also just a week away from the budget. So a lot that could really change or what we need to be anticipating, what we're going to be waiting for, looking forward to. So let's see what we had. At least what the benchmarks did yesterday was manage to snap their two-day losing streak there, showing us that there is still some momentum left within the Indian markets and an upside expected further from here. Although the GIFT Nifty right now is indicating a flat to a positive start, one would say, for the Indian equities, especially on a day when it is the F&O expiry. If you look overseas, where we saw Wall Street and those futures pretty much oscillating between gains and losses, but in proper trading hours, we did see the S&P 500 and Nasdaq extend their 5-day winning streak. Investors, of course, need to be watching out for the US Q4 GDP data, which will be due later today. As for the Asian markets, those ones are trading quite in a mixed range this morning. But if you have to look at what is happening back home and where the money is really coming in or flowing out, well, foreign institutional investors have maintained that selling pressure in the cash segment at least, and this for the 6th day or in a row, one would say, offloading close to 6,934 crore worth of shares in yesterday's trade, according to the provisional data, whereas DIIs, they've tried to bring in, or at least try to match up and trying to buy as many shares, and they've bought in a 6,012 crore worth of shares on January 24th. And of course, we are in the thick of the earnings season. So the earnings that you need to be watching out for today are going to be Tata Tech, SBI Cards, ACC, Adani Power, HPCL, JSW Steel, TVS Holding, Vedanta Limited, among others. So that's pretty much what is going to be looking forward to in today's trade. Before we start, but let's also get you a roundup of what we're looking at from the F&O band, because today being expiry, it will be interesting to see how the new series proceeds. But for today, the NSE has gone on to add a Z Entertainment Limited once again into the F&O ban list for January 25th. Remember, this has seen an in and out over the past whole week, and because there's so much of headline making news, in fact, we will be discussing that in details later on the show as well. But on the other ones in that ban list, we've seen NSE has gone on to remove Balrampur Chini, IRCTC, Nalco, as well as Oracle Finance and RBL Bank. Those ones have been removed from this F&O ban list. As for the Nifty PCR, now the PCR, or the put call ratio that we say, pretty much which indicates the equity mood, that has climbed by 0.92 versus the 0.74 that it recorded the previous session. So we could still say that it is in the favor of the bulls pretty much, because that PCR number is below 1, which indicates that the traders are buying more call options than put options. So pretty much bullish sentiment, we could say, or at least yesterday what we saw in that last hour of trade, that buying that we saw, or maybe short covering, you can call it, because we are so close to an expiry. That's perhaps what transpired in trade, but that's where we also saw a really good recovery from our markets, right? And that's where we're actually going to see that momentum, if it able to sustain it into the new series. But of course, we also had a whole slew of earnings that came in yesterday. One of the major ones being from the auto pack. We did see Tata Motors as well as TVS that came out with its numbers, and both of them were quite beating analyst estimates, one could say. Now, the two-wheeler and three-wheeler maker, and I'm talking about Bajaj Auto in specific, recorded a 37% year-on-year growth in its standalone net profits, coming in at 2,042 crore rupees, whereas it did see broad-based double-digit growth, we could say, across all of its segments. We are seeing revenue from operations also growing by about 30%, coming in at 12,113, whereas we are also seeing the EBITDA, that was the highest ever level ever recorded in a quarter, coming in at 2,430 crore rupees. This also up by about 37%. Margin improvement 100 basis points by about 20.1%. So You could say this the least, because that's what we're actually seeing transpire. Now, we have discussed whether it was, the premium end or the entry level that is really perking up these stocks, and we'll discuss that further with our guests. But let's look at market opening. That's the opening bell there for you on January 25th. We are seeing the Nifty, some bit of pressure, we would say, but just about 0.2% down, 50 odd points, and that's pretty much what we saw yesterday also on that flat line. At least the benchmarks perhaps will need some bit more of momentum through the day, and will catch up eventually to end this truncated holiday week. But let's look at the other sectoral indices and what they are indicating. Bank Nifty also seeing some bit of pressure, but still above that 45,000 levels, which is a good indicator, one would say, at least in terms of holding on to that support there. Let's look at the other sectoral indices for now. And mid caps, mid caps and broad caps. Now, those ones have been pretty much the outliers, or at least yesterday they did mirror the sentiment and saw a good uptick of about 1.5 to 3%. We saw the mid cap and small cap move yesterday, and now pretty much 0.5% up again there that you're seeing on the small cap. So pretty much the broader indices, one would say, are still managing to show that bit of relief. Nifty IT, though, down and about, and this could be after we saw a good set of numbers, though, from Tech Mahindra, but the IT pack as a whole not really giving you that much of relief in that sense. Almost close to a percentage down, the Nifty IT index that you're seeing on your screens. Let's go to pharma. That one too down by about 0.2%. Pharma has also been an outlier, but it does move, individually. The stock-specific action is where it really changes. FMCG also looking at some bit of pressures now in initial trade. What we're seeing down, consumption though holding up, but just about flat, one would say. Those are the names that really, change the or really show what the rural sentiment is also about. So seeing some bit of relief there. Metals, now that is one that we'll be talking in detail also, especially after what China has done with its RRR cuts, and that really helping metal stocks. We've seen the likes of from Tata Steel, JSW Steel, also earnings that are coming out for these counters. Auto, they're in the positive this morning, and of course, after all of those earnings that we're seeing, pretty much what we expected the auto sector to do. So we have those big names, we have those good earnings, like I was just pointing out about Bajaj Auto, TVS also giving the same kind of earning results. So pretty much that also holding up for the auto beat. Nifty Realty, they're 1.28% up there. I think this is the biggest gainer, one would say at this point, the sectoral gainer at least. Good set of numbers coming in from, we saw the likes of Oberoi Realty to win DLF yesterday. Of course, brokerages may have, different kind of views on how they want to be looking at the realty sector at this point, but there definitely has seen that, that turnaround is what is happening for real estate. So we need to see how that really transpires and which should be the stocks within this pack that we can be looking out for. Let's look at the top gainers and losers then, and who's really contributing to those gains on your screens there. On that top gainers list, Bajaj Auto, Adani Ports, Coal India, Hero MotoCorp, Bajaj Finance, as well as Adani Enterprise. So we're seeing good number of auto components there. L&T, NTPC, as well as Titan, all making it to the top gainers list. Let's look at also the flip side and the losers then. On your screen, we have Tech Mahindra, of course, after those earnings, and we were anticipating those kind of results and the stock to be reacting to it. HCL Tech again, Infosys, so pretty much all your IT names there in your top losers list. And of course, we've been seeing this because of earnings pretty much. So that is where you're seeing also Tata Steel. Now, this could also be because of their earnings, although they've managed to turn profitable this time around compared to the losses that they've seen in the other quarters. So we'll discuss those in detail, in fact, to see what stocks and what's really changing things for that matter. Let me also take up TVS Motors. Now, that one also did clock in about 68% on a year-on-year growth from its net profits, coming in at 593 crore for the quarter ending December. Revenue from operations increased by 26%, coming in at 8,245 crore rupees. We're also seeing a rising sales, where this has risen to about 27 odd percent, coming in at 10.63 lakh units. So this is quite good. EBITDA has grown by 40% on a year-on-year basis. Margin expansion of 110 basis points. Now, if you have to just compare Bajaj Auto and TVS, both of them showing 100 basis points margin expansion. That is pretty much what we can cheer for the auto pack, and we'll discuss that with our guest. Let me also quickly take you through Tata Steel numbers, because that one, like I was pointing out, it recorded a net profit of 522 crore versus the loss that I'd seen of 2,502 crore on a year-on-year period. So pretty much healthy operating numbers there. Also, the fall in input costs is what is really driving these numbers. Revenue operations have though fallen at 3.1% on a year-on-year basis. EBITDA has surged to 54.7%, coming in 54.7%, coming in at 6,263 odd crore rupees. So quite a good set of numbers from Tata Steel, one would say. In fact, CLSA has given an outperform call with a target of 145 per share. So let's discuss Tata Steel and how that is really going to pan out, especially given the fact that we have this the metals pack and how they have been reacting to the news that's coming in. Plus, we have all of these results, and joining me for that is Shivangi Sharda. Good morning, Shivangi. Thanks so much for joining us. Let me, I've already given a list of earnings that we've seen, and pretty much those stocks reacting in trade and seeing those kind of volumes. But first, let's get your view on Tata Steel, because this is coming at a time when you're seeing what China is doing. It has gone ahead and cut its RRR rate, and that is also transpiring, or you're seeing that trickle down effect. So what would be your call on Tata Steel at this point and the metal pack as a whole?
For having me. So we've seen that there has been a lot of swings in this counter. Tata Steel, in fact, the entire sector is quite cyclical, so we cannot rule out the kind of wild movements that the stock sees. Week on week basis, we've seen that there has been quite a lot of strong support based buying, which is around about at 128 odd levels. But then again, we've seen that upside is a little bit capped because of the call writer sitting firmly in the stock. So we could expect a little bit upside over here to around about 140 odd levels. But then again, it's quite capped, and 133 would be a crucial support to watch out for the stock.
That's your target for Tata Steel. Shivani, also before, let's also understand from the auto pack. We just went through all of those numbers, and we're seeing some really good, at least we wouldn't say turnaround from the auto pack, but at least the two-wheelers showing some bit of, good double-digit growth. How should one be looking at autos, and what would be your picks if you had to give one from this sector?
So, looking at the entire auto and auto ancillary pack, I am liking, auto ancillary pack better. Here, there are, stocks which have remained in a range despite of the volatility of the market, and they've remained quite a lot resilient. So, over here, I'm liking Apollo Tyre, which has been making higher highs, higher lows from on a week-on-week basis. Even the monthly basis, we've seen that there has been strong volumes that have been added in this month so far, and we've seen that good amount of buying is there at any small decline. So this stock is looking quite nice, holding on to its crucial support zones. 542 would be the next targets which we can watch out for. 510 with as a support level.
Right. Well, Shivani, thank you so much for giving us your picks also there and joining us live on this broadcast here. Well, let's also look at the fundamental picture and where India really stands out through all this. Yes, we've seen a couple of volatile days in terms of, how our markets are reacting. Not so much so from what we're getting in our global handovers for that matter. But in India, what are equities really reacting to, or where is that next trigger point going to come in from? And joining me to discuss all of that as well is Dipan Mehta. He's the director of Elixir Equities. Good morning, Dipan, and thank you so much for speaking with us here at Money Control. Now, let's get first to the market and see why it's reacting or behaving the way it is. We've seen some sharp cuts come over this previous week. You could call it a correction or just a pullback, and maybe we need more definition just to understand what is happening here. But are we likely to see, can we say the worst is over or is yet to come? On which side would you be at this point?
Good morning and thank you for having me on your show. No, I think the worst is yet to come and we are anticipating a deeper correction. Technicals are looking a bit weak according to us, and the earnings season, apart from a few stray stocks, have generally been largely disappointing. And I think a lot of froth is there in the market, a lot of trading leverage positions are also there. So I think that we could see a kind of a shakeout taking place in the market over the next few weeks or so. From that point of view, we want to be a bit cautious.
Right. Now, reports are indicating that, with SEBI set on imposing this tightened ultimatum for the beneficial ownership norms for overseas investors, which comes into effect from Feb 1st. Is that, do you think, one of the major reasons that we're seeing this sell-off, and especially for FIIs, pretty much an outflow for the 6th day on a trot? What could be a better explanation if not, these SEBI rules? Are there any other headwinds that you see?
No, I don't think it's to do with that. Our focus is more on the corporate earnings. I think they are a bit disappointing and valuations also are very rich. So usually what happens when the earnings season is ongoing and companies come with results, there's always a reality check as to what the trading 12-month numbers are and how the forecasts look, and then comparing that with the presently traded price. There's a kind of a reality check, and right now I think a lot of stocks are trading at very rich valuations.
Right. So rich valuations is a given. And, we had this argument even before saying that, well, if India does have all the macros working for it, then investors should be paying that premium and it shouldn't really hurt them. But I want to get back on your point on corporate earnings. And you're saying, well, the numbers are not really telling a good picture. But we are seeing, like, if you have to look at what the auto pack has done with the two-wheeler segments, they look convincing, from the metal pack as well. So maybe IT, yes, didn't deliver this time around, but probably wasn't that factored in. Which are the sectors that you're saying has not really lived up?
I think banks have been largely disappointing because of squeeze in net interest margins. And if you see the pre-provisioning profits, those have been in like low double digit or so, even flattish. And a lot of the net profit gains have come through lower provisioning, and that cannot last forever. Also, IT companies, software companies, large cap, small cap, across the board we have seen large cap companies came with numbers where there was no expectation, but the actual numbers were pretty stagnant. Mid cap IT companies came with numbers which were up to expectations or slightly below, but by and large, the growth is slowing down over there. So from that point of view, we want to be a bit cautious. And I think it's just to do with valuations, base effect coming into play as far as, corporate earnings are concerned. And some of the momentum indicators also are not that great according to us.
Right. So which would be the sectors then that we could be, if you're trying to navigate this and you're saying there's more correction that could come perhaps, then what would be the safe havens, or where should one be really looking at, to navigate this volatility?
No, I think the safe havens would be pharma. We have seen good numbers coming through from the pharma companies. In any case, pharma is a defensive sector per se. So from that point of view, I don't expect much of it would remain an outperforming sector in a declining market. Apart from that, by and large, I think, it will be an across the board correction, which is expected in stock prices. And, I think the maximum damage may come in the banking sector and to an extent in mid-cap software as well. We saw the way Tata Elixir corrected, the other day. So it's not that we are in complete blue sky scenario, nor is it that it is extremely cloudy skies as well. So it's just that we are seeing a mere, I would say, a pause in the bull market, which we have seen for the past several months or so. This remains a multi-year bull market, but you could have corrections, and this, I think, is one of the corrections which is underway. I do feel that this phase of the bull market is over when the Nifty crossed 22,000, and you could easily see a 10% up for correction, maybe even testing of the 200-day moving average.
Right, so you're saying 10% correction is what we could be looking at. So there's further downside for now. But if I have to look at the broader perspective about where India stands, let's also look outside and see this China plus one factor is really something that has worked in our favor. Now, if you have to look at specific sectors within this that really go on to gain. One would say metals I would put in place right now, since after China has announced the RRR cuts, that has really lifted our metal pack, at least here back home. So how do we navigate, like, how does one play these cards when you're seeing some bit of, recovery in China, which is helping us, but also we have our in-house, the Indian factor that can really work. So first, give us your view on the metal pack and how should one be looking at this sector, and then your overall on how this China plus one strategy really augurs well for India.
So China plus one, of course, is a long-term benefit for a lot of companies, manufacturing companies per se, but it takes time to actually percolate down to the earnings. And China also is not just going to, roll over and let India gain market share. So they're going to have their competitive strategies in place. That's one part. And coming to the metals part, I think, yes, these are cyclical companies. 1 or 2 quarters go good, then 2, 3 quarters do not go that great, and very difficult to keep a handle on them. So by and large, investors should avoid cyclical industries because they don't have a complete knowledge about when the underlying fundamentals of the industry do change. And when we are expecting a correction, I expect that investors should try and get somewhat into cash. And if there is a correction, kind of a deep correction where mid-cap stocks can correct by 25-30% or so, then if you have cash in your portfolio, then that can be strategically used to buy good quality businesses, which may then be available at reasonable valuations. Right now, the challenge is that any decent business which has consistency and longevity in earnings and growing at 15-17% or thereabout is trading at a P multiple of beyond 50 times, 60 times trailing 12 month. So price earnings to growth ratio is extremely high. And we'd like that to correct either through earnings moving up, which may happen over a passage of time, or actual correction of the stock price. So from that point of view, it's better to just stay a little light at this point of time and just wait and watch. Especially when the earnings season is on, you can expect a lot of stock-specific volatility, which can kind of create opportunities or risk factor as well.
In fact, since we're talking about the metal packs and earnings, we are going to have TV Narendran, the MD and CEO of Tata Steel, later on Money Control. He's going to be speaking to us exclusively. So do catch that interview at 3 p.m. Today right here on Money Control. But let me go back to Dipan then and get a sense, because we're talking about portfolio building maybe at this point. Do you think, you did mention about valuations being stretched, but then if one has to look at, deciding between large cap, mid cap and small cap, what should really that portfolio look at, and how would you be allocating if so?
See, I think my preference is for large cap stocks. I think they are safer at this point of time, and valuations also at least are not completely, completely way out. So from that point of view, the larger companies, including software, pharma, Reliance, banks, is where a large portion of your portfolio should be. But, I'd still be cautious on the market, and I cannot say that, this is not a market where one should get extremely aggressive and start to take leverage positions or start to put a lot of money into the market. So it doesn't matter, whether you have a large cap slant or a mid cap slant. It's important to have the right mix of cash and equity in your portfolio, and also to ensure that the quality of your portfolio is exceptionally good. Because when a correction does come in, the bad quality stock can correct much more than the good quality stocks.
Dipan, before I let you go, definitely need to ask you, we are just, a week away from the budget. Of course, this one just being an interim one, but there are hopes that we could hear some bit of measures also, because it is ahead of an election year. So what would be your expectations from Finance Minister Nirmala Sitharaman? Give us both from the corporate side as well as what you think will actually play out.
No, I think whatever we wanted from the finance minister, she has already given over the past several years or so. We wanted stability in tax regime, that she has completely delivered on, and all the budget estimates, the assumptions are extremely realistic, and then whatever collections are taking place are beyond the projections. The government spending has been increased significantly. We are seeing that in railway stocks and defense stocks across the board, in engineering companies as well. So what more can you ask the finance minister? I think all we can say is thank you, and let this budget be a bit of a non-event. There'll of course be some amount of rhetoric on spending on schemes to kind of give support to the poor, to the farmers, and increased spending on infrastructure. But we've heard all of that before. And from an investor's perspective and as well from a corporate perspective, I think no news is good news as far as the budget is concerned.
Right, so you're not expecting any great surprises there from Nirmala Sitharaman. But like you pointed out, we've seen most of these PSU stocks at least do really well in the run-up, and that perhaps, everyone's anticipating some kind of news. But do you think now would be a good time then? And PSUs, what would be, which sectors among the PSUs would you then look at if you had to make a choice?
I think there's a trading opportunity in oil PSUs. I've not been a great fan of these companies. They've not created a lot of wealth in the past several years or so. But purely on account of the fact that oil prices are stable to declining, there could be a trading rally over there because these companies benefit tremendously when crude oil prices are pinned down. Apart from that, I think at corrections, defense companies, railways companies, where there is a huge order book position, those also one could consider. But I repeat, it has to be at a correction. At these levels, I think a lot of stocks, I would say 99% of the stocks are overvalued by 15-20% or so. It's not that they don't have a great long-term future or there's the fundamentals are in any way a threat. It's just that, when you buy even a good quality business at a high valuation ratio, even if the company does deliver on its profits, the stock price tends to underperform. So from that point of view, investors need to be a bit careful.
Right. Well, Dipan, it was a great pleasure talking with you and helping our viewers there with, how one should be navigating the current market volatility and scenario, and going ahead what we could really expect our Indian markets to do. Thanks so much, Dipan Mehta there, the director at Elixir Equities, joining us this morning. Well, with that, it's a wrap and goodbye from the entire team that puts this piece together. Thanks so much for watching in. Do post us your feedback in the comment section below, and also wishing all of our viewers a very happy Republic Day in advance and the long weekend ahead. We leave you with some visuals of the Finance Minister at the Halwa ceremony at North Block yesterday, which marks that lock-in period for the last leg of the budget.